afternoon from the Shreveport office of Eagle Financial, a wealth care company, for the latest edition of the Jack and Bill Show, the March 8th, 2024 version. So it's been a few weeks since we've done this, William, and we wanted to kind of just talk about, there's really kind of been a craze going on in the marketplace outside of cryptocurrencies, this thing called the Magnificent Seven. And the Magnificent Seven is 7 large cap stocks that have performed spectacularly well, I would say, over the last 5 and 10 years. And last year, we've largely seen a continuation of that this year, with the Magnificent Seven up about 16% year to date. Now, there's an exchange traded fund that's equally weighted of the Mag 7, and it rebalances quarterly. That's MAGS. That's the security that's up today about 2%. Bringing it up to 16% year to date. By the way, the broad market, for comparison's sake, the broad market is up 7.5% to 8% through right now, which we have the S&P 500 up approximately 8% today, with the NASDAQ markets up more, the Dow down a little bit less. The Barclays aggregate index year to date is slightly down to flat, given good news in the bond market and bond prices, this week. So, Bill, let's just rattle off, and I'll just tell you. So, the Magnificent Seven is Tesla, down 28% so far this year. Alphabet or Google down 4%. Apple down 12%, Amazon up 16.5%, Meta or Facebook up 45%, Microsoft up 8.5%, call it, and Nvidia busting through the $900 level today, up 85% in basically 2 months and a week this year. And so, Bill, what do you have to say about that?
It's amazing.
It's amazing.
The first thing that comes to my mind is that this Mag 7 is an outgrowth of the FANG. Remember that acronym from just a few years ago?
Facebook, Alphabet, Nvidia, Google.
Netflix, wasn't it?
Oh, maybe it was. It was Netflix.
Netflix was in
I think it was Netflix. It wasn't Nvidia. It was Netflix.
Dan's giving me a thumbs up. Netflix. Netflix.
Yeah.
So it's just a continuation of that, and so it's these mega cap tech and communication services names that have really taken over the market. And there's a number of ways we can look at this. Probably the easiest way to look at it is to look at the S&P 500 and compare its performance to an equally weighted S&P 500. This is the fact sheet for the S&P 500, which the S&P 500 is probably the most popular index in investing worldwide, and it's been in existence
1957.
You're right. It was created in 1957. Yeah, and so it's often used as a benchmark for investment performance. If we look at the S&P 500, it is capitalization weighted, meaning that companies with the largest market cap, and that is defined as the number of shares outstanding multiplied by the price per share, the companies that are the biggest have the biggest representation in the index. And what we saw last year was the S&P 500 had a tremendous year, driven by these big cap names, these Mag 7 names, basically drove the performance of the index. and compare that to an equally weighted S&P 500, that performed half as well.
It's interesting to look back 15 years. I recently did a 15-year look back. If you could have looked at the equally weighted S&P for the last 15 versus just the regular straight S&P 500 cap weighted, and the equally weighted has outperformed the S&P 500 significantly. Now, excuse me. And this is where we've gotten on this. I recall we were doing a seminar at year-end last year. If you take the S&P 500, these are 500 of the greatest publicly traded companies in America. Okay, 500 wonderful names. If you take 1% of those 500 names, that's 5. The 5 biggest 1% of the names now comprises something like 28% of the market cap of the whole index. So those 5 names are really what moves this thing. If you look at it for the NASDAQ 100, NASDAQ 100 is essentially the largest 100 stocks. Overwhelming majority of them have a stock symbol that has 4 letters or more, typically trade over the counter. And the NASDAQ 100 then is the 100, call it the 100 largest names. I recall looking at this late last year, and the top 10 names, was it the top 10 or the Mag 7, comprised 60% of the market.
It was the Mag 7.
The Mag 7 comprised 60% of the market cap of the NASDAQ 100. And I've got to think with the Mag 7 up 16% year to date, those numbers have gotten worse. So we wanted to talk about this because there are at least 2 sides to every story. Okay, even our political race.
Well, yeah, there's your truth and my truth, and then there's the truth.
That's right. So that's the thing here. So here are the 2 obvious sides. Think whether you're in these things. What do you do now? Or you're watching them go up, and you're not in them. You might be in them. You're probably in them to some extent and may not know it. Okay, so the number 1, is this stuff too high and too volatile?
Yeah, great starting question.
Then number two, well, I'm a young buck and I'm long-term oriented. And what about this artificial intelligence thing and the growth that's going to come from that? And think NVIDIA and how much demand there is for semiconductor chips for the next 10 years or 20 years. So there's the other side of that story. And then I would say, given those 2 main stories, one's a positive and one's potentially a negative, where you have, what do you do? What do you do with that? What do we do? And I think that's really, some of the things that we wanted to address here. Or what do you do given the impact that's had on the market? How does this impact, how we feel about the stock market?
No, great.
Yeah. So dive into some of that.
Here's an initial thought. There is this school of thought about passive indexing, and we can thank Bogle at Vanguard for ushering in passive investing. It has really taken a foothold in the investment world. Passive investing has overtaken active investing. There's more money in passive ETFs than there is in actively managed funds. Passive investing has proven its mettle, no question, and it is an easy way for investors to get exposure to the market in a cost-effective manner and passively doing so without having to be proactive in managing a portfolio. So people have looked to indexes like the S&P 500. Hey, here's 500, as you said, Jack, 500 of the greatest publicly traded companies in this country and in the world. Why not just stick my money in the S&P 500? It's a market cap weighted index. So those companies that do the best at growing their market cap, I'll be participating in that. Look at the Mag 7, for example. These companies have grown their stock prices, and so I'm participating in that growth. All valid points. I would say to that, when you make a decision to invest in a passive index product like an S&P 500 ETF or mutual fund, you are making an active choice. Yes, you are making an active choice to own those 500 names and the weightings of those 500 names. And so right now, your investment portfolio is highly concentrated in a handful of names that have already had a huge run up. And if you look at the S&P 500, let's say it's been doing this, and then you've got the S&P 493, and it's like, wah, wah. So something has to give here.
Let me ask you a question, Bill,
Yeah.
for our audience. Let's just say that a nuke goes off in Israel, God forbid, or some geophysical event occurs, or a terrorist attack, something that, let's just say that the market would fall 20% next month. How would these things do?
My expectation would be, if we have a correction, and it doesn't have to be something driven by a big risk like that, it could just be a normal correction. My expectation would be those things that have gone up the most will come down the hardest.
And why's that?
Well, historically, stock prices should rise commensurate with earnings growth. And so you can look at a company's earnings growth year after year after year, and so the stock price growth should be commensurate with that. But what we've seen is their stock prices outgrow their earnings growth, and that's called multiple expansion. So you're paying a higher price to earnings multiple for that same earnings flow. And so that means you're paying more than what you would have paid in the past. And at some point, investors are going to say, you know what, I don't think it's worth that much, for that future earnings stream.
I think you could liken this period that we're in potentially to 1998 and 99, leading up to the year 2000, when S&P 500, I think in 2000, the S&P 500 fell 8.9, in 2001, 11.8, in 2002, it was down 22.1. And it, from peak to trough, it fell 58%. But during Q1 of 2000, and I was in the business back then, the tech bubble came undone. We had the NASDAQ over 5,000, and it went all the way down to under 1,500. Think about that.
Has it recovered its high?
Oh, absolutely.
Just recently?
No. It recovered its 2021 high recently.
Okay.
So it's much higher than that. So, but that's a good point, because in 2022, we had the S&P 500 down 18 to 20%. The NASDAQ market was down something like 33. If you fall 50%, you have to make 100% to get back.
Yep.
If you have $1 and you lose half of it, that's 50 cents. You need 100% or a doubling to gain that back. So we call that, or statisticians would call that, there's statistically a volatility return penalty. The greater the volatility, the greater the difference between the arithmetic and the geometric mean returns on a long-term basis. And that is, so the NASDAQ market, you'd think after last year, I think the Mag 7 last year made 75%, but the Nasdaq market did not recoup what it lost in 2022 until was it Friday or Monday this week? I mean,
Well, even the S&P 500, because of the correction in 2022, had a great 2023, but over those 2 years was just kind of flat.
yeah, I would say a counter argument to this bill, and I think it's very important to not dig our heels in and be adamant about,
Anything.
anything at all, because the market will prove all of us at different times to be idiots, especially.
I'm digging my heels in on one thing. Dan got a good haircut last week.
That's good.
Anyway,
Yeah. So here's the other side to that is that, I mean, the people that are in these things, the young bucks that say they love technology and I'm investing for growth. There's an argument that like software companies and growth stocks, always have earnings, regardless of what the business cycle is doing. Companies like people are going to watch Netflix. People are going to use Facebook and social media.
well, I think what you're describing,
People are going to use their iPhones.
you're really making a case for how this growth cycle differs from the tech bubble, because these big companies, the Microsofts and the Googles and the Amazons of the world, I mean, they've become like utilities.
Yeah, and they have become like utilities, and they do have earnings. The tech bubble back then had a lot of stuff that was pie in the sky.
Pets.com.
And that's right. The average .com stock in 2000 lost 95% of its value. The overwhelming majority of those stocks did not come back. There was a .com mutual fund that I had someone bring that into me and ask me what they should do with it. It was down 95%. I'm like, well, first off, you can hang on to it, but they're probably going out of business next year. I mean, yeah, you might as well start over. These are real. I mean, Tesla is the worst one of the bunch this year. A lot of people would say, well, I don't want to invest with Elon Musk. He's a pot smoker, or someone says he does cocaine, or anyway. I was listening to someone at lunchtime today say that he's the modern Ben Franklin, inventionist.
He's a genius.
And I love how he's trying to unify America with free speech.
But we are seeing a divergence in the Mag 7, because previously we were just seeing them all move in concert, and now we are seeing disparate growth patterns or performances.
Oh yeah, and if Tesla were to fall 50% this year, it might be the Mag 6 next year. Because like you just pointed out, Netflix was a FANG, but it's not a Mag 7. Oh, okay, so this thing is always, evolving, and I guess it would be helpful to try to give some somewhat conclusive advice to our viewers about, well, what are we doing about this?
Well, and how about before, if
Yeah.
I may, I mean, there's still some other things that come to mind on this. You mentioned AI. That is a theme that has really taken the markets by storm. And this whole AI phenomenon took root in January of last year, and people were spending money like crazy on anything, any stock that they felt could benefit in some way from AI. Well, is AI viable? Yes. How long will it take before we start seeing real AI applications? I don't know, but it sure seems like.
I mean, you could argue that we already have.
Well,
like Chat GBT and stuff like that.
But
or
it seems like the
robotics.
The market has really priced in, because the market's a discounting mechanism. It just seems like the market has really priced in the future applicability of AI in these businesses. And there's a lot of themes that come and go. I mean, I think about these thematic investments like cannabis, 3D printing, even blockchain. And isn't it interesting that Wall Street will come out with these thematic products to meet demand after the fact, but not in anticipation of demand. So when you start seeing Wall Street come out with AI themed ETFs, maybe that's time to take a pause, because they're only thinking about how they're enriching themselves with these products. That's more important than you making money on your investment.
No, that's a very good point,
And
Bill.
when it comes to growth investing, there is a growth cycle or a business cycle with all companies. Companies that are early in their growth stage, they're going to have the fastest growth early on. And so that's why it's helpful to catch these companies before they reach large cap status, when they're still small cap. And you're taking bigger risks by trying to find and identify those companies and catch them on the growth upswing. But at some point, you start to see maturation in the growth. And so these companies, they're living high on the hog with AI and other things. But at some point, there will be market saturation, and the growth will start to come down, and earnings growth comes down, and with that, share prices. That's pretty simplistic.
Yeah, I mean, it's like technology changes.
Just technology in general.
What I haven't bought a buggy whip in recent years.
Well,
I mean,
10 years ago.
But
You did live in Pennsylvania.
Yeah, so this is the thing that we would say. So you said something that was interesting to me, Bill, when we kind of started out, is that a passive investing has overtaken active investing. But if you make a decision to be passive, you're kind of starting out being a little bit active. But we would say even so, we're active managers, but we actually have core satellite. We have core products. Our clients are participating to some extent in this stuff, even if we don't own an ETF that's called the Mag 7 ETF, or even if we don't. And we do have exposure to some of these names, even individually, with in some client accounts.
There's so many ways to slice and dice it and express your views, thanks to the proliferation of ETFs. Like maybe you do want these names, but you don't want the weightings. Okay, well you could do an equally weighted.
There you go. And almost every client that we have has exposure to the equally weighted NASDAQ, and we own some other.
Maybe there's some measure that you would rather emphasize in your investment approach. Maybe you want to use a quantifiable measure like free cash flow, which is something that we do look to.
Yeah.
In our investment portfolios.
Even like the buffered ETFs, though.
Correct.
You've got exposure to the Mag 7, in there.
But you've got some downside protection.
That's exactly right. So, that's the thing that oftentimes when you'll see some names like that really racing off into the stratosphere, it could be pointing to a market top. And so those are the things, our clients, we have many engines of return with our client portfolios, and there are some areas that look exceptionally attractive and cheap to me, like short-term bonds. Bill, you just bought a bond that comes due in September that's yielding over 7%. So we see, given all the Fed tightenings, short-term bonds, I think there's a 73% chance the futures markets are indicating of the first Fed easing in June. 73%. So we've got a Fed funds rate at 5.25 to 5.5 that's going to stay there, likely at least until June. That's much higher than historical standards for short-term interest rates, and we can get substantially higher than that. We own some corporate bonds that are well into double-digit yields, believe it or not. that we believe are high quality. And then see, my wife is trying to call me. She's going to have to wait on that one. So, but we also we own managed futures. We own a multi-asset strategy in the managed futures space that is. Bill just turned you on. We're doing the Jack and Bill show live. So I'll hang up and call you back. So I'm sure. So then we own a. You realize we own a managed futures strategy that's up over 1,000 basis points year to date. It's made over 10% already this year. It has far less volatility
and is way diversified
than the S&P 500. That's right. That's managed futures and MSCI World Index overlay, and then 40% of their portfolios is in T-bills, paying over 5%. That's 3 engines of return, arguably more, in one bundled mutual fund that we own that's really kicking butt for us right now. So, and then it's like you said, a lot of our ETFs that we own that we feel will do very well, whether the market favors growth over value or whatever, and that is a cash cow series of ETFs that equally weight in different capitalizations and internationally and globally, a whole product suite of ETFs that look at free cash flow to enterprise value, the best performing companies with those highest multiples, and they rotate that in there on a quarterly basis.
And that's called factor investing. So free cash flow to enterprise value is a quantitative factor, but it's a factor that has really done well. And if you think about cash flow is the lifeblood of a business. And if we go into an economic recession, wouldn't it be nice to have exposure to companies that generate lots of cash?
I would call that an accounting-based metric. When you use the term quantitative, it is quantitative, but most people think of growth stuff. But anyway, but you're exactly right with that, William. So yeah, so that's our point. As a firm, we're not rushing to own these names right now. You know, we that could change. I mean, if you were to dissect them, I mean, Tesla, for example, down 28 this year, or Alphabet down 4, or Apple down 12. That might be more appealing to look at names like that than chasing Meta up 45% or Nvidia, up 85%. So I've got a hard time buying anything right now that's already made 85% in the last 2 months.
The hardest part for an investor in this market climate is psychologically, it's that fear of missing out. Gee, everyone else is making these, huge returns on these Mag 7 names. I want that. And so it always seems to happen. It's only after we've seen a run up in something, then we start getting the phone calls. Hey, what about getting me some of this? Well, it could be a great company, could have a great product or service, but the price is not right. And price is important. Price is very important when it comes to investing. So sometimes you're better off just being patient, letting things that are, you see it. I mean, when you see the index moving like this and you see that name, coming up like this, and then it shoots straight up. Anytime something is shooting straight up, parabolically like that, no thank you.
Yeah, I'd like to reiterate that, Bill. So it's one thing to identify really good companies or great companies. Then it's another thing to buy them at attractive prices. And that's what we try to do with all of our investments. We want our clients' monies allocated to those things which give us the most return per unit of risk.
Oh, but people don't want to look at it that way, Jack. They just want to look at, what's generating the highest return. But they don't want to look at the other side of the equation, of how much risk are you taking to capture that return. So
Yeah.
the risk adjusted return is very important.
That's exactly right. Yeah, and I think that pretty much captures what we wanted to discuss today. If anyone out there has a question or a comment, or would like to have your portfolio, looked at, we would love to. We welcome a phone call, email, stop by the office, have a cup of coffee with us, and thank you for watching.
Thank you.